Hello and welcome to the home of high probability trading. My name is Tim and I'm one of the traders here at the live trade room. And we're about to trade the US Open, fully live and interactive for you. So we go through the process involved in getting set up for a market open where you get a flood of capital coming into these markets, and as a result we'll see if we can capitalize on some high probability trades. Just before we begin, those of you that are genuinely interested in learning how to trade these markets, you'll get a good insight into how we trade these markets from a position of, I suppose, knowledge and understanding, and we can absolutely support you along this journey. So it is, if you go to a website, thelivetraderoom.com, we've got a whole variety of different, we've got a wealth of content in there. We've got 4 different educational coaches that's structured education designed to sort of progress your knowledge and understanding about these markets while you're active involved in trading these financial markets. The education is very, very important. But also the application of that education is equally as important. So we've got this little blend of absolutely educate yourself. We've got over 50 hours of education there across 4 different courses. But most importantly, experience how these markets ebb and flow. Experience how profitable traders get in and out of these markets, and that education is profoundly important for any trader. And you can join us every single day. We've got multiple live trade rooms, and you can join us for as little as $15 per calendar month. So I'm sure you'll agree that price point is incredibly low. There's no sort of contracts. There's no you don't have to set up trading accounts. There's no complexity to it. All of that has been stripped away. There is nothing more than just your monthly fee to us, and that's how we've set up our organization. So, and if we can help you, we'd be delighted to do that. So, go to our website for more details. There is a chat function there, and if you've got any questions, of course, feel free to get in touch with us. Okay, so let's get straight into it. Then we'll start with our risk warning. Please see our risk warning currently up on screen now. And we'll see what opportunities we have this trading session. So yesterday was quite an eventful one in the end. We eventually got the moves that we were looking for. We needed to be patient, but of course today now we're getting these little bear traps, and I'll explain what we mean in just a second. We're getting a little bit of a reversal on yesterday's selling. So we've got a way in which we can position ourselves for potential moves. So I'll get into it in a little bit more detail. Okay, so first things first, we want to be mindful of some of the major news events in these markets, and we don't want to jump in 5 minutes before a major news event. That's just not good practice. We've had an RBA statement. Anyone trading the Aussie dollar? If you look at the Aussie dollar, and we will do now in just a moment, but we've seen a bit of strength, and that's no real surprise, really. We've seen the dollar actually reverse yesterday's strength. So the dollar's now has been relatively weak over the course of the trading session so far. But we'll explain the technical differences with this with the dollar strength trade at the moment as things currently stand. So today now is, we also had mildly positive employment data coming out of New Zealand. That's no major surprise. The employment figures are improving across many of the G7. So no surprise to see a very marginal uptick in the employment change numbers and the unemployment rate as well. So that's obviously quite positive for an economy. So you're likely to see a little bit of an uptick in the New Zealand dollar, which is what we have seen in line with the weakening dollar across the board. Okay, so with that in mind, what news events do we have? Good afternoon, Con James. Good to have you back. So if we have a look, and I think one of your questions here is, you have got a question regarding the ADP non-farm employment news and the ISM services news. How will they both affect gold and the indices? Okay, so firstly, it's important to know what these news events are and how kind of important they are for traders. Not for us, for traders, for global investors and traders, and the banks, and the financial institutions. So all of these news events all play a specific role in a bigger picture. So the unemployment situation, the manufacturing services, retail sales, for example, they all play a specific role in terms of the overall prosperity within an economy and the confidence behind that economy. So, and these events play a specific role in that. So there's a huge focus on employment and unemployment. So we've heard a lot from the Fed in terms of this inflation story, prices ticking higher. Is it a concern? Not really, because what we would need to see first is the unemployment rate decrease drastically. If you think about it, the more people that are employed, the more likely they are to spend, the more likely prices are to push up. And under a situation like that, it can become quite a challenge. So we'll take these two individual, you were talking about the ADP numbers and the ISM numbers as well. So with the ADP, so this is a number that around the financial crisis, the non-farm payroll is the big jobs number. It's the government issued employment stats, and that's really what's important. The ADP was designed as a bit of a prelude just to ease the market into what's likely to come on Friday. And as you can see down here, we've got non-farm payroll. This is your government-led employment data, and this is, I suppose, the ADP numbers are a prelude to that particular event. So it can often give you a guide. However, the correlation over the last 12 months with COVID has been a little bit on the erratic side. So we'd be a little bit cautious now in terms of tracking the ADP or following it to any sort of stable extent. So it's a reflection of the employment change. It's a reflection of the health of the economy from an employment perspective. So that's the ADP number. How does it impact gold and the indices? More people are in employment, the more money people could spend, the better that is for your companies, your stocks, and as a result, your indice markets. So broadly, employment up, indices up. Now, if indices are up, then that's a risk-on market condition, and you're likely to see capital coming out of safe havens like gold and the yen and the dollar. That dollar weakness, and you're likely to see that capital move into stocks and shares and the indices. So how does it impact the two? Slightly differently. If we get a positive employment number, stocks are likely to push higher. Gold is likely to sell off. Now, the problem with gold is it's crossed with the US dollar. So it depends whether we're seeing a dollar strength or dollar weakness. But we would expect to see dollar weakness if the stocks push higher. So it puts the gold market in this little strange sort of dilemma. The gold market can move because of a flight to safety, where capital's coming out of more riskier assets and going into markets like your gold market. So it can move because of that flow of capital, but it can also move because it's crossed with the US dollar, and it can depend on the relative strength and weakness of the US dollar. So this is all quite complicated stuff. We've got hours and hours and hours of education on topics just like these, and the application of these particular news events. So this is just a little snapshot. So that's the unemployment numbers. I think you mentioned the ISM as well. Today we have the services number. So yesterday, I think it was yesterday, we had the manufacturing numbers. Did we? Was it yesterday? Sorry, it was actually Monday. Sorry, each day now seems to blur into the next one. So on Monday we had the manufacturing data. So this is your PMI numbers. This is your product manager index. So our producers. It's effectively a survey, and they ask a whole range of different questions to these. Purchasing managers, that's it, that's the word I was looking for. And they're asked a whole series of questions, and this is put into a figure. And above 50 in manufacturing in the US implies growth. Below 50 implies contraction. If a manufacturing sector is performing well and it's above 50, it's expanding, that's good news. That's good news for stocks. That's good news. That's likely probably to put a little bit of pressure on the gold market. It's also good news for the dollar. So there is this conflict of interest there. It will depend which will win out ultimately. So if the indices do nothing, what you might see is the gold market spiking as a result. So this is a I suppose a data point which just focuses on US manufacturing. It's in a good state. You can see on Monday we were expecting 65 figure, and we saw a 60. So what that is saying is it's expanding, but not as fast as it was expected to perform. So that might contribute to a little bit of weakness as well in the industry markets. So today now, is it today or tomorrow? Tomorrow, I think, is the ISM services. So tomorrow we'll be looking at the services sector, and that's lagged behind manufacturing just a little bit. And again, we're expecting a nice positive expansion as economies start turning online. Services are expanding and growing. As a result, we're likely to see the rollout in the US is the vaccine rollout is performing really, really well. Over 200 million vaccinated now, and it's going up exponentially. I don't know what the exact figure is now. It's probably 220, 230 million, somewhere like that. So the services number is likely to be positive. Will it be in line with manufacturing and not quite as per expectations? And these news events, you can see it's a medium impact news event. It's not a high impact news event. So be careful about tracking it too hard and putting too much importance on it, because it's not really a high impact news event. But that's ultimately how it can impact. If it's positive news, it's likely to be supportive of indices. If it's negative news, it's likely to be, it might put them under a little bit more pressure. And the current focus really right now is all on inflation. It's all on, prices will be going up, but how quickly and how fast, and to what level will these prices increase? That's the big concern, because we found out yesterday, sort of post the event, that Janet Yellen, who's now the Treasury Secretary, made a statement in an interview where she said, of course, the central bank will be increasing interest rates. Now, that's a pretty major slip up. And I think it is a slip. I don't think it was intended, because she then tried to retrace her, sort of backtrack on what she said. But the markets had already reacted by then. So everyone knows that the rates are going to start increasing. It's just a case of when. And, do the markets have enough faith in the Fed with regards to their interest rate expectations and the timing of those interest rate increases? Because if the market loses faith in the Fed, things will happen very, very quickly. You'll see people jumping out of those markets, and the equity markets are in a state of sort of anxiety at the moment. That's probably the best way to put it. That probably wraps up yesterday's selling. Just anxious, those that are not that committed to the upside got very, very nervous yesterday. They dumped their trades, and we saw some considerable selling. Now, that's comfortable for us to get into to the downside. So we were happy to try and get into those trades. Now we're getting these bear trap moves, so I'll come on to the price action in just a moment. But James, does that answer your initial questions there? Really good question. How do these news events, impact the indices, the dollar and gold and things like that? And it's a constantly evolving situation, so it's worth. It'll take a little bit of time probably to become really comfortable with it. But I'm sure you'll get there. Yeah, hope all is well with you, and that you have a great trading day. Yeah, hope you do as well. Even the Dow Jones went down to 33,760 area, which you were talking about yesterday. Absolutely, yeah. Just and you've mentioned it. It was a crazy day yesterday. Yeah, it was just an anxiety-fueled sort of dump, really. Our overall, and the problem we have with it is that we are, and it's probably a great opportunity actually to jump over to the charts now, and we can see. So with today's nuts, of course, this is we've had a bank holiday on Monday, so it's kind of thrown my week out completely. Of course, today is Wednesday the 5th. Yes. Okay. So now we're back on track. Yes, we do have the ADP and the ISM numbers today, and crude oil inventories. So we'll see the stockpiling of crude oil and see how that impacts price. So those are our news events for the day. So ADP at 1:15, and yeah, we've got ISM at 3 p.m. So we'll take all this into account when we're trading these markets. So what I'll do is we'll just put up last night's trade plan. It's important to plan these trades as best you can. And what we're really seeing on screen, I'll see if our Squawk service is still on. It is. So what we're seeing is a bit of a rejection of yesterday's lows. We're currently in the S&P to the downside. We're a little bit offside on that. And we are selling the euro dollar below that 120 level. That's really quite important. So a bit of a false breakout in both of these markets over the course of yesterday. However, what we saw yesterday across the indices markets is actually a very significant move. They've voted with their feet to push prices lower, and yes, they have retraced off the lows, and yes, the overall trend to the upside for these indices markets is clear and obvious to see. But we're getting a bit of buying creeping in today. So what remains to be seen is how committed are these buyers to pushing price to the upside. Or do they think...
And vaccine news from the US, the CDC director Walensky says now more than 40% of US adults have received their COVID vaccine.
Okay, so 40% in the US, so that's a very, very significant number. 60% is expected to be herd immunity, in and around that kind of number. So they are well on the way to achieving, I suppose, coming out the other end of this horrendous 12-13 month period that we've been in. So we've got a bit of a rejection of the lows, and now today we're seeing a bit of buying. The question now becomes, is this a bear trap where there is commitment to the downside, but you're getting this little bit of sort of market resilience pushing prices higher, and will we eventually get that little rollover trade back to the downside? That's where we're at short term, i.e. over the coming hours and days. We want to see if these markets can roll over to the downside, because if you look at markets like the Nasdaq, this is a structural failure to the downside. And if I just get up our pen here, so I'll just get this pen up on screen now. So this is an important bit of price action. It's a double top. And it's your M formation for those of you that are proficient with technical analysis. So we've seen a bit of a commitment below this level to the downside, and we've had an uncomfortable little reversal trade so far. But here we're going to have strong levels of resistance at a slightly higher price. So your first trade in situations like this, and it's not just us, other traders will be looking at these levels as well, is looking to sell the breakout at that 13,700 level, and also the pullback. So don't forget the breakout is trade number 1. So that's your breakout trade, and what looks like is in the pipeline is a pullback trade, PB for pullback, and this is trade potentially number 2. So the reason when you work with support and resistance, these markets often give you 1 if not 2 opportunities to get into it, and they do this at every stage on the way down. If the markets are moving in that direction, you get 1 or 2 opportunities many times, and all you're doing is just working with those levels of support and resistance to sort of navigate you in and out of the trades. So we're currently, we've seen the commitment to the downside, which is really why mentally we're keeping that downside trade at the forefront of our minds. We're not going to completely rubbish it and start jumping into the upside now, but we do need to see certain things happen. We need to see prices struggle to make new highs, and prices start to roll over to the downside, and if so, we can stick with it. But that's the situation we're in right now, and we can see that across all the indices markets. So yesterday we had some strong selling. The S&P is probably in the worst condition, really, in terms of the size of the pullback yesterday. And what's worth noting is the size of the pullback just prior to the close. So we had a what's called, I suppose, a normal pullback, and then as the market closed, we saw a really strong accelerated move from 41.48 up to a high of 41.70. So, you know, a 22 point move in a very short period of time. And you can look at this, the ATR, which is the average range of a market over the course of the last 20 days, is only 37 points. So, you know, we've seen a 22 point move in the last few minutes of the trading day in those markets. So a little bit of excessive price action, and currently that is still intact, that impulsive move. There's a lot of resistance around these levels. This market has to work quite hard. You can see all the levels of resistance just sitting in at this level. So this is a strong level of resistance, which is really why we have our stop loss just above these levels. But it's clearly threatening to make new highs. So that's kind of the precarious position we're in just right now at these current prices. So we're getting that bullish bit of price action across all the equity markets. And what the decision-making point for us actually doesn't necessarily come today, but it does come tomorrow. So what we mean by that is if markets close like this, and then tomorrow we break above the high, and we get that confirmation that prices are ticking higher, then we kind of want to be out of that trade. So today we just got a little bit of a question mark over today's buying. How genuine is it? The US Open will be a good indicator of its true momentum. Will we start to see further selling, or will we start to see, you know, these markets genuinely tick to the upside? So there's a bit of a question mark over these indices markets as things currently stand. So bear that in mind. And we are still technically, certainly in the NASDAQ and the DAX, we're technically below strong major levels of resistance. And we're kind of at those levels now as far as the S&P is concerned. So where does that leave us with the dollar? So if we're in a risk-on market condition, we could expect the dollar to start to weaken. And that's really what we're seeing. We're seeing the dollar look like it's weakening across the board. We'll have a quick look at the dollar and you see where we're at. So very mild dollar weakness against the euro, strong weakness against the pound. Nothing, they've kind of cancelled each other out as far as the yen's concerned. Mild weakness against the Swiss, strong weakness against the CAD. So I know a few of you are still in this sell trade. So what we really want to see happen now is this market to just close below these levels, the 2260 level, which will 2266 level to the downside. We'd expect further continuation lower if that's the case. And look at the price at which yesterday's market bounced off that level. You know, this is what we were talking about yesterday. This is a strong level of resistance. So, you know, if we closed quite high and then we got some extension, it would be time to get out of the trade. We saw a rejection in yesterday's trading. We reversed 50% of the trade. So that implies, you know, we're likely to get some selling coming in. So we're heading lower, it looks like, with the CAD. The Aussie is quite strong today. You can see the up and down nature. This is what we mean by these markets, and it's kind of alternating. So you get buying, you get selling, you get buying, you get selling, you get buying, selling, buying, and then it starts going into that sort of buying, selling, and we're now in that little zone again. So, you know, those of you that are interested in kind of patterns, tomorrow we'd expect a little bit of selling. Now we'll wait and see, but that's just what technical analysts do, is they look at these market conditions and it can guide them. It can guide them for some relatively short-lived opportunities, like those that are that like your scalpers and things like that. Like what we're looking for is something slightly different. We're looking for almost a swing trade. So we'll see this little pattern and we'll want to break above this level to the upside, or we want to break below this level to the downside. And which way will it go? We don't really know yet. Do we mind if it goes to the upside or to the downside? No, we don't mind. We're very comfortable going with whatever direction this market takes. And we want to see the correlations across other markets as well if we can. So what we can categorically say is we're firmly in a risk-on market condition where we're seeing some weakness in the US dollar. I know many of you look at gold, so we'll have a look at that now. How is the gold market playing out with this market condition? It's not really giving any opportunity right now. We've been in this little zone now for 3 weeks, and it looks like it's continuing to move sideways. So at this current price, do we have any indication whether prices will push to the upside or to the downside? The answer is no. There's no trade here right now. And we do realize many of you like to focus on one or two markets. But if you're trading gold, all you're doing is forcing a trade, because you're firmly inside really strong sideways moving market conditions, and those are what we regard as relatively poor trading, high probability trades. Sorry, they're probably medium to low probability trades. That's how we would sort of interpret those. Okay. So gold market is not really giving any particular bit of news on this one. We've got crude oil inventories today. The price action so far has been mildly bullish, but as you can see, we're pulling back to yesterday's high, the 66.15 level. Will we get a big move prior to crude oil inventories today? Probably not. It's probably going to wait now for the opportunity to arrive. it's a sort of a higher risk trade, but the opportunity was kind of yesterday, very early on, around 64, 62. And we've been looking to buy this above the 63.25, which is it's kind of above this level sort of 5-6 days ago. So crude oil, probably not the greatest opportunity. Just looking at the yen pairs, we've got kind of a mixed bag against the yen. So the dollar's not really doing much against the yen, so they're both as weak as each other. The pound yen is probably giving marginally the better opportunity. Perhaps tomorrow we'll have a little bit more clarity with regards to the yen. When you get too much indecision, i.e. against different currencies, and you're working too hard to determine what market is strong, what market is weak, what it implies is there's indecision there. So, you know, that's not the best condition in which to be making trading decisions. So you want trades to jump out at you, to be clear. Like yesterday, we spent a bit of time talking about the equity markets, you know, pushing lower, and they were stacking up. There was the correlations in there. Let's do your. The correlations were stacking up. The price action was quite bearish yesterday, and you know, the correlation with the dollar was intact as well. So everything was in line to try to capitalize on yesterday's moves. So, and these were the markets that we were looking carefully at in last night's webinar. So, as always, trading is really about your ability to prepare and be ready for these moves in advance. And now we're going to identify these opportunities and see truly where the opportunities lie in this trading session. And at the moment, it's a little bit of a mixed picture. The buy trades, as far as the indices markets, are likely to kick in tomorrow, because we don't like these bearish price action one day followed by bullish the other. We're not going to get caught into that sort of being pushed around these markets from trader to trader, from trade to trade, you know, looking to sell 1 second and buying the next. All you're doing is being pushed around by these markets. So yesterday we saw the significant break of major levels of support to the downside. While prices are below those levels, we are, for the time being, looking to remain, are looking for opportunities to continue to sell, even though prices are currently reversing. So today may very well be a bit of a frustrating trading day. Certainly the way that we trade markets, and we're looking for high probability trades, and you know, today's buying, it could be, has the potential to be a bear trap. So the prices are still likely to push lower, but we're getting a bit of persistent buying creeping into these markets across the board. The correlations do, to be fair, stack up as far as the dollar weakness is concerned. So yesterday might be the anomaly, and today might be the true direction. So we'll get more confirmation on that tomorrow in tomorrow's trading conditions. So we do have ADP in about 20 minutes. The employment numbers, that's likely to shake. In fact, what we'll have is the markets will open at 1 o'clock. We probably wouldn't be expecting too much activity on the open with the ADP, the unemployment numbers due out 15 minutes later. But you know, perhaps then we're likely to get some activity across these markets. So if there's any questions, if there's anything we've covered that perhaps you're unsure about, or you are in any trades that you'd like us to look at, we've got a bit of time now if you'd like. We have our trade plan. We know what we're looking. We know which markets we're looking to trade. We know the direction in which we're looking to trade them, and we roughly know the prices that we're looking to engage. So, just to let you know, some of the things that we talk about all the time to our traders, those that are genuinely interested in learning how to trade, is not about your trading strategy to any great extent. Yes, it's important. Your risk management is very important. Your ability to manage that trade is very important. Trade selection is very important. Which market should we be focusing on? There's a lot to choose from. How do you make those decisions in terms of which markets we should be looking at? The direction in which you trade, don't get pushed around by these markets. All of these things are quite important. Where do you place your stop loss and how do you calculate risk? All of these things formulate, I suppose, a trader's toolkit. But what's really important from, I suppose, a personality perspective is that you're consistent in what you do. If you can imagine, if you're chopping and changing the reasons why you get in and out of trades all the time, you'd never find any stability. So consistency in what you do is really important, in our opinion. Being disciplined with your capital. This is your hard-earned capital. Now, we don't have any requirements from any of our traders to depositing any amount of cash into any account. You won't get any of that from now on. The reason why that's important is you can actually learn the skills. And we're interested in developing traders with skills and knowledge and understanding about what we're doing. We don't always get the markets working in our favor, but we do want to plan and prepare for the opportunities before they happen, and then we're able to execute our trade with a certain amount of knowledge and understanding behind those trading ideas. That's what trading is. That's what your institutional traders do. Yes, there is technical traders, there's fundamental traders, there's traders that trade sentiment. They all have these aspects to their trading, but principally they're very consistent in what they do. They're incredibly disciplined with their capital. If a trader at a financial institution, makes an awful lot of money, but is a bit reckless on the risk side, they're probably out of a job. So yes, you've brought in loads of money, but unfortunately you exposed a large percentage of the company's capital. You're out the door. And we know a few examples of people that's actually happened to. You get certain situations where, like that, I can't remember that fund, just 6-8 weeks ago that went bust, to the tune of sort of 10 billion. That's mismanagement of risk. What's astonishing is the leverage that was used across many different financial institutions. They all misunderstood the total exposure, and obviously they've burnt and they've paid a big price and stuff, and they're well capitalized to be able to do it. But the point is, there was a complete mismanagement of risk, and for us, it doesn't matter how much you're trading, whether you're trading £200, £2,000, £20,000, £200,000. The process of trading for us is exactly the same. The amount of capital you have is completely irrelevant to us, because you can calculate trade size suitable for the amount of cash that you have available, and that's what we mean by discipline. And the third sort of pillar, first is consistency in what you do. Second is discipline with your capital. This is your hard-earned cash. Don't throw it away. There's a lot of traders, getting very, very badly burned out there. They're jumping into markets off a whim of some positive news or some, meme stock that they're just getting carried away with other people. They're not making independent decisions for themselves. They're trying to ride the crest of a wave. And I suppose there's a saying in trading, which is those that know the least lose the most. And that's probably quite true. Overall, you get the odd person here and there that just purely luck. It's like going into a casino and just putting your money on black. in the roulette table and rolling the dice and see what happens, and all of a sudden you're walking out with loads of cash. Like, it's a similar situation for many people trading these financial markets. There is a very real reason why your financial brokerages are seeing triple-digit returns in terms of revenue and profit. The reason for that is more people are trading, yes, but more people are losing money. So it's a trade-off, the one versus the other. And people are coming into this environment. They don't really know what they're doing, and they're getting burned left, right, and center, and until they can't take it anymore. And then they'll say, "Oh, trading is a load of rubbish." But those that are consistently profitable, can make money grow. And we've got our Capital Growth live trade room every night at 9:45 for about 15 minutes, where you can grow capital over the medium and longer term. And then we've got other trading sessions for day traders that are more active during the day. But irrespective of what time frame you're trading, patience formulates an awful significant part of trading markets, not just for us, but for your institutions and everyone. Clicking the button at the right time is a skill that you will develop over time. It's not something you get straight away. And sometimes we've got the right trade, but we've got the wrong entry or the wrong timing. So we might have to get into the same trade maybe 2 or 3 times before we get paid on it. So our analysis is fine. What we're seeing is a little bit of short-term volatility, which perhaps stops us out of the trade. And then we see prices rolling back in the direction which we're looking to trade them. And then it's the decision, do we get back in again or not? If the conditions are as they were when you first got in, then you can absolutely take that decision to get in to that trade once more. So, sorry, I do digress just a little bit. So thanks for bearing with me on that. But just a little bit of insight into, I suppose, trading and some of the skills that are needed. And we talk about trading skill all the time. It's not luck. You're looking to stack the odds in your favor when you trade markets, and you're doing so from a position of knowledge and understanding. There are trade ideas that you develop, and then you execute that trade idea. Okay, so Sarosh, what do you think on the pound dollar short below the 39.11? What you're doing is selling a bullish market. So I'll show you exactly. So we can see that just very quickly on the euro dollar, prices. This is on the 15-minute time frame. We've peaked at this level. We've just made a little low, and we've tried to make a new high, and now we're getting this little. Okay, it's on a 15-minute time frame, but this is your first structural failure to the downside, and this is what we're looking to see if that dollar strength trade still exists or not. On the daily time frame, you can see it's pure indecision, really. We've had a bit of a rejection of the 120 level. Prices are just obviously above that level, and we only want to be selling this market below the 120. We don't want to get into it at these higher prices, just in case. You don't want to get in. You don't want to sell a market above support. So the pound dollar, Sarosh, you can see we've got a bullish trading day today. So the pound is stronger than the dollar. Okay, so I hope you would agree that that's the case. What we can also agree on is the market has a little bit of, over the last few weeks, there's a mild sort of bearish view to these trades. And you could probably draw a more accurate top end little trend line up there. But if you zoom out a little bit and you get a little bit more context, we were firmly in a really strong uptrend for quite a while, and now we're just in this little sort of consolidation bubble, really. And broadly speaking, from sort of end of February through to early May, we're pretty much moving sideways in these markets. And I suppose just reverting to your question, do you think, what do you think on the pound dollar? Short below 39.11. So zoom in on the daily time frame. So you're talking about getting in at these little prices now. What you're doing is selling the highs. So it's a trading strategy that works for some. Probably your more knowledgeable traders, those that have significant experience under their belt, can trade the highs, can sell the highs. And what that means is it's a bullish candlestick. So you're talking about dollar strength and pound weakness, but the market is proving itself to be doing exactly the opposite to that. So yours is a counter trend. It's a counter trade. So it's a contrarian trade, isn't it? So we can clearly see prices are pushing higher, and you're looking for that sell trade off these highs. There's nothing wrong with it. There's easier trades out there, for example, breakout trades and pullback trades, but you're looking to sell the highs, and that's a slightly different mindset to perhaps what we adopt, and it's a little bit more challenging environment to be looking to sell those highs. Now, just to follow on from your thoughts, we can break this down in a little bit more detail. If you look at this, in fact, let's go into the hourly. So what we can clearly see, and significant volatility, firstly, that's the first bit, from 139.60 to 138.00. We saw a really strong move yesterday. Was it the day before? No, it was at the end of April. And we've seen the reversal trade kick in as well to the upside. So we're very much up and down. That's the first thing. We can see the volatility, and straight away we're not sure. Okay. And then we can sort of take these highs. It's a strong level of resistance. And if you wanted me to pick a direction from here at this point, it'd be to the upside. So it's not a great quality trade is what I'm saying. It's a medium quality trade. It's probably a medium probability trade to the upside. And you're looking for potentially a sell trade to the downside. And I'll show you how we can justify a sell trade. So let's say, for example, we take these highs and we take these little swing lows, right? And prices has pushed to the upside. We've bounced back, and then we just make that little concerted move to the upside. So let's say prices bounce off this 139.27 again, and we create a bit of a low. So if you can imagine, if this is the flow of price action in this market, and then we attempt to make a new high, but guess what? We failed to make a new high. Then this price in here becomes this is your high, this is your lower high, and this is again another high, another lower high. And what you're doing is you're reversing this little bit of price action in here. So you have these lows, you have these higher lows as the market pushes higher, and now the psychology of this market changes completely, because now you have a higher low in here, but now you have a lower low, and this is the reversal. We call it a structural failure. So this is when prices and the psychology, this is where the psychology...
We're just under 10 minutes away from the bottom of the hour and the release of the ADP employment change for the month of April. Median estimate for today is 850,000. Range of estimates between 525,000, one spot 125 million. That's against a prior increase of 517,000. Just taking a look at the preview from TD Securities, they're looking for an increase of 775,000 for private employment in April, surpassing the already robust 517,000 seen.
Okay, I'll come back to the news event now in just a couple of minutes. But is your psychological sort of shift in this market where all of these buyers are now panicking to get out of those trades. So these are your breakout trades, or these are your structural failure breakout trades almost. But trading inside this zone is a little bit more riskier, because if you put a gun to my head and say pick a direction, I'd be looking to buy it. I wouldn't be, because that's not the type of trades that we get into, certainly through our trading channel at the live trade room. With our personal capital and our personal trading account, then it's a different situation completely for us. But if we want to be consistent and disciplined and patient as well, then we teach traders this type of price action, where these psychological shifts in these markets, where the transition shifts from buyers to sellers, and that's really what a market is. It's a battleground between buyers and sellers. It's nothing more complicated than that. And what you need to determine is who's in control. And that's why I mean, like, it's difficult to work out who's genuinely in control. So you're just seeing prices fly higher, fly lower, reverse, and it's a bit of a messy type of situation. So in the situations like that, we're often going to be a bit more patient. We're not going to be, committed to buying the pound dollar as a result. And it's not to say that it won't go higher or it won't go lower. It's just it doesn't fit with, I suppose, our style, our strategy, what we look for, the conditions that we want to meet before getting into a trade. So if this market sort of starts to roll over and we get a little selling trade, maybe around, probably a little bit lower than the price that you were looking at, maybe something around the 138.95, something like that, so 15-20 pips lower than kind of what you're looking at, then we can stack up. We can say that there's a structural failure to the downside. We're seeing lower highs. We're now beginning to see lower lows on the trade. We can look at the correlations, and the dollar is beginning to strengthen across other markets. The indices are ticking lower. So all of these, all of a sudden, you're actually putting together a bit of a. And we do a lot of this obviously in our head when we trade now, and it gets to that stage where it becomes quite automated. But effectively, you're building up a case to get into the trade. Is there anything negative about it? Yes, there is a lot of sideways moving price action over a prolonged period of time. So that's a concern to the downside. But if you go through the analysis and you go through the different pros and cons of each trade, you can make a decision and you can say, right, well, I'm gonna sell this trade or buy it, whatever you want to do. But I am concerned about this. So what I'm going to do is I'm going to reduce our risk on the trade. So we will bring down our risk slightly. So instead of a 1% trade, we'll bring it down to perhaps 0.8. So 0.8%. So that's really what we can do. Or if it's a 2% trade, we can bring it down to 1.5. And it's only because we are going through the process of active trading, and we can say this market has a lot going for us, and we're going to look to still sell the market as you're looking to do, but we need all of these conditions to be met, and then of course there's many more, and that becomes an awful lot easier very quickly the more experienced you get. And like I said, we've got a wealth of education available that we spend hours putting this together for you in a very easy to understand, very graphic, very practical sense with examples, and you can see how these patterns play out time after time after time again. So did I answer your question, Soros? So really, there's no sell trade just yet for us. It's bullish. It's likely to continue to the upside until something changes. and it's that change that would trigger a sell trade. It's just in this precarious position right now, bit of a question mark over a sell trade, to be fair. You know, you can make trading as complicated or as easy as you like. For us, we want to go with the momentum, and clearly today it's to the upside. So we'd only be looking for a buy trade right now, which would be obviously counterproductive for your sell trade. Now you can get very good at selling the highs if certain conditions are met, but have those conditions in place, predetermine what those conditions are. For us, it's these structural failure trades, which I've just talked you through. So just getting close now to this news event. So we do want to monitor all of these markets at this time. We want to keep an eye on the euro dollar. So we want to we can see that the pound is, the euro pound is strengthening. We got into that at 86.39. So we got into it just below that 86.42 level. In fact, that's marginally higher. So so this is a breakout below the daily high, below the daily low to the downside. So a decent move in that. So we'll expect further continuation to the downside. So let's have a look at the S&P and the euro dollar as we go into this news event, and we'll see what's likely to win out. Right now, we're getting a bit of an uptick.
1 minute till the ADP employment change, looking for 850,000.
So what we'll do is we'll just bring this across just a little bit. We'll keep an eye on the euro dollar, see what's happening with the dollar, and we'll keep an eye on the S&P 500. Sorry, let me get to grips with this first. So today is Wednesday. So this is the news event we're looking for. 115 ADP employment change number. So we're looking for 872,000 jobs to be added. So that's the figure we are looking at.
742,000 for ADP. 742,000 below the 850,000 expected.
Okay, so we've had a bit of a miss with this number. So we're expecting 872 and we got 740, I think it was. So we'll just see what that number is. Sorry, I wasn't. So yeah, 742. So as you can see,
565,000 from 517,000. Just to recap, ADP employment change for April comes in below expectations, 742,000 versus 850,000 expected. The prior has been revised up to 565,000 from 517.
So it's 130,000 jobs less than expected. So we'll see the initial reaction. Let's look at the S&P on a 15-minute and just see. We're just seeing that strong uptick. So we're seeing a little breakout to the upside as far as the S&P is concerned. The euro dollar, very marginal downtick, isn't there, recently? This is on a 15-minute time frame.
A bit more colour from the ADP report. The ADP payroll increase is the largest since September 2020.
So will we start seeing some dollar strength? So at the moment, we're seeing the indices markets, recently just make new highs. They're looking quite bullish for now. We'll just give it a few minutes just to settle and see where the opportunities might lie. We got that all-important 120 level, which is here. That's this little yellow line on this chart. So obviously we want this market to roll below that level. Then the likelihood of further downside is more important. And these markets are correlated. So if the stock markets push higher, if the S&P pushes higher, what we're likely to see is the euro dollar pushing to the upside. If we start seeing some selling creeping in, it's likely to support our euro dollar sell trade. So far we're getting a little bit of a rejection on the S&P. We want to see if we see the same across the board. I'll go back to our earlier conversation about a dead cat bounce, where you get commitment to the downside and you get some buying coming in, and what we're looking for is some rollover price action, and we just haven't seen any of that just yet. But it's not to say that we won't get any. So this is a dead cat bounce. You get the very significant selling creeping in yesterday, and you get some buyers coming in. You've been quite bullish with their cash and their mentality, and what we want to see is that mentality just be tested a little bit, and see if some sellers start to come into these markets at these highs and start putting that market under a bit of pressure. Then it becomes a case of, right, well, what do these buyers do now? And the psychology of these markets are constantly shifting. So if these markets can't make new highs and they struggle to do so, then you can imagine, if you're trading big capital, doubt starts to enter into your mind, and then you might start making decisions to start liquidating positions, and then that just gives more momentum to the sellers and start pushing prices lower. So the euro pound is making good moves to the downside. Should be 86.43. $86.43. Okay. So if we just have a quick look at the ADP number, it's 130,000 job miss, so that's a significant number. And the question becomes now, will we see a similar So the question becomes now, will we see a similar... So this is the jobs number really over the last 12, 13 months. So in May, we saw the figures off the back of the initial lockdown. We saw unbelievable numbers, 20 million jobs lost in the US. The month after, it was followed up by 2.7 million. And then we started to see an initial bounce back last summer in the US. We saw 2.3 million jobs added. And then we're sort of in this little up and down little phase. Nothing quite like we saw initially. I suppose businesses began to adapt to a certain degree. And now we can sort of see so you can see that we've had quite a reasonable jobs number. The ADP is relatively positive. It's just not quite as positive as we would have anticipated, or the markets anticipated. And the markets are a discounting mechanism. So what that means is they'll always be looking at these figures, and they'll be determining at what value should a market be, bearing in mind the information that is currently known. So if we're looking, and this is why you get these projections, is because, and forward guidance as well from central banks. So this is why we get these estimates, because the market can correct itself depending on the jobs number, depending on expectations. And if the jobs number is 990,000 jobs added, so nearly 1 million jobs being added, if it exceeds that and we get 1.1 million jobs added, that's obviously a very, very good news story. And the value of the dollar is likely to increase as a result off the back of that, and the equities can push higher as well. And if it's a strong miss, let's say we got 500,000 jobs rather than 900, then hold on a minute, that's not a good thing, and you might see some dollar selling as a result. So these markets will constantly discount prices depending on these news events, and some news events are far more important than others. Like the non-farm payroll is far more important than the ADP. The ADP gives you a little bit of a snapshot just to see the jobs number. This is sort of non-government jobs number, but the big news really is on Friday, which is why this is one of the biggest news events of the calendar month. It's in the top 2 perhaps, so 2 or 3 events. So very, very important. There's your ADP number. We're expecting 872,000 jobs. We saw 742,000 jobs added, and this is the prelude to the non-farm payroll on Friday. Okay, so where are we at with these markets? The euro dollar, we've just bounced off the 120 level. The euro pound is continuing its move to the downside below the 64.43. Sorry, the 86.43. Excuse me. We're not really able to break this high here in the New Zealand dollar. Will we get some rollover price action kicking in? Which goes back a little bit to your comment there, Soros, just regarding the pound. Will the pound start to roll over to the downside as well? You see, we'd want something a little bit more pronounced, but you do have your push to the upside, you have your pullback, you have your attempt to make a new high, and then you might be looking at a sell trade around those lows. So that's when it does begin to fit a little bit better in terms of a sell trade. Plus, of course, we can look across other markets and think, right, well, now we are technically below that 120 level. In the euro dollar,
we're just under 3 minutes away from the bottom of the hour. Possible comments from the ECB's Vasilej, the governor of the Slovenian central bank. No mention of this on the ECB's website though, so we're not expecting a text.
And the dollar Swiss, we're seeing the dollar potentially gain a little bit of momentum. The dollar CAD's bouncing off the lows. And the same with the Aussie and the New Zealand. It's just not as bullish as it was perhaps half an hour ago. And that's when the psychology begins to shift. And, you know, traders are absolutely looking at this euro dollar trade. And they'll be deciding, all right, do I book in profit on this buy trade now in the New Zealand and the Aussie? And this is where you might capitalize on a sell trade. Is all of these buyers that have done well out of this trade today might start liquidating that position now. Off the back of a bit of dollar strength. So it's looking a little bit healthier to the downside than it was perhaps half an hour ago, and we are technically below that 120 level. So all of these things are very important. Also, Soros as well, just consider the round numbers, the 13900 important levels, and just maybe just see that break through to the downside. But what we generally avoid doing is selling a bullish candlestick. We'd much prefer to sell a bearish candlestick. So we want to sell bearish candlesticks and we want to buy bullish candlesticks. Sounds simple, sounds straightforward, and it is. It's nothing more complicated than that. The challenge becomes the execution of those trades and the profitable risk reward, and making sure you risk your capital correctly and being accurate in how much capital you're committing to a trade. And of course, your overall exposure as well needs to be taken into account. You don't want that to be a certain, an uncomfortable percentage of your capital. All of these things formulate, I suppose.
The US Treasury announcing their quarterly refunding there to sell $58 billion in 3-year notes, $41 billion in 10-year notes, and $27 billion in 30-year bond auctions will take place next week.
Okay, that will be an important event for these markets.
Treasury says the recent efforts to increase the coupon auction sizes has been sufficient for their near-term projected borrowing needs.
So,
it says the seasonal or any unexpected variations in the borrowing needs over the next quarter are to be met by changes in the bill auction sizes and cash management bills. The Treasury says they do expect Congress will raise or suspend the debt limit in a timely manner, may take certain extraordinary measures if Congress does not.
Okay, so the US government can raise cash through bond auctions where they sell bond auctions. They sell bonds. Like they just announced, there is a 10-year bond auction next Thursday, the 12th of May. And prior to that, there is... Sorry, where was I? Yeah, so we have the 10-year, and then we have the 30-year. That's the yen. So yeah, the US. So your 10-year and your 30-year bond auction, and I think there's some other selling other paper as well. So that's when the government want to issue bonds, which guarantees a kind of a fixed return on that bond over a particular period of time. The 10-year bond, for example, is, if you buy a 10-year bond, you'll be looking at 1.6% return over the course of a 10-year bond, and same for the 30-year. You'll have a bond value or a yield that's created off the back of that so-called investment. It's not really an investment because it gets eroded by inflation. So it's just a place to store money, and it's not a particularly efficient place to store money, which is why we had this uptick in bond yields in the first 3 months of the year. Very important to note, if you're trading markets and you're investing, to be mindful of the bond yield. You'll hear about it all across the news, and the reason why this increases is because a government wants to sell debt and no one wants the debt, so the yield goes up to encourage a government to generate debt. So if you can imagine, if a government needs to raise cash and no one wants to give them the cash because they think they're mismanaging their economy and they're not handling things that great, then that's a bit of a game changer. And that's why these markets freaked out for the first few weeks of the year, is because the rate of change in the 10-year yield was actually quite significant, and there was a sharp sort of, from, let's say, February through to sort of mid-March, so about a 6-week period, we effectively had bond yields move from 103 right the way up to 1.73. So you're talking about a 7/10 of a rate of a yield increase in 6 weeks, and that is very, very significant, and it freaked the markets out. So we need to be mindful for that again, because if you're monitoring these bond yields, and that's why next week's bond auction might be really quite important, because if the demand is not as per expectations, then you'll see the stock market sell off in a big way, and therein lies the potential opportunities for some of these markets. We are likely to get a few years of some incredible moves in many of these markets. So entering these markets at this point is not a bad thing to do. If you speak to us, it's all about educating yourself to trade smart, not be frivolous, not be impatient, to really kind of know what you're doing, develop a trade idea, and look to execute that trade idea. If you speak to any profitable trader or any investor around the world, they develop trade ideas based on information that they've attained, and they make sort of fairly common sense decisions to either buy or sell stocks and shares or bonds as a result of the market conditions, what the information is telling people. Same for us. It's exactly what we do. So gold is taking a dive. It looks like gold is taking a dive. Yeah, probably because we might be seeing a little bit of dollar strength. Looks like it's beginning to creep in. We can't really call it dollar strength just yet. We can against the euro, so the euro is one of the weakest markets out there today. So gold. I get the feeling, James, that you're a bit of a gold nut, are you? Is that one of your favourite markets? We kind of want to trade what we see, and what we can see is this market has failed to kind of close above the 1790 level to the upside, and approximately the 1765 to the downside. It's at these levels we'd be looking to engage. Trading up and down in this kind of zone might just be a kind of a frustrating situation, and it obviously does depend on your approach, of course, but So we'll be watching carefully for a bit of a close below this level, just at these lower levels, 1768. And if the dollar starts to strengthen, that could actually become quite a decent sell trade. And this is what we mean. If you do your analysis and you're trading in the direction in which this market is clearly moving. So there is your downtrend. So we can all agree on that. So our approach for gold would be, we'd be looking right now until something changes. We'd be looking for sell trades, and you can look for decent sell trades when prices interact around these levels. So there's nothing too sophisticated, is it? It's just looking for selling opportunities. So then we zoom in a little bit more and we can see, right, well, we're looking for a sell trade. So we know which market we're looking to trade and we know where roughly we're looking to get in. Now we can just assess the price action on its own merits and say, well, we've actually got an M formation, which is actually quite bearish in its own right. So, and this is why I said below the 1768, if you see a close below that and then you see some continuation, then you'd be back on to the downside, and there's your ascending level just going through that price. So you begin to stack all the odds in your favor for that downtrend. Structural failure, the overall trend is lower. We're getting a good run up in terms of volume and price action. Structural failure trade to the downside, and a break back below the monthly low, perhaps something like that. So there's your down trade, and you're good to go with this, with the sell trade. But you're talking in and around the 1760 level. That would be a decent price to sell this market. Then it remains to be seen whether you can be patient and wait for that trade to develop. Preempting the trade doesn't sound like a great idea because there's strong rejections to the downside, and there's lots of potential support in at these levels. So that's basically it, guys. Listen, I do apologize. We've got another trading session to go to, so we have, in fact, I'm late. So on that note, we just have a quick look at these. So we're getting the S&P just beginning to roll. So there's a little bit more. It's not as bullish as it was. Let's put it that way. The euro dollar is selling below this level. So we want to try and give the euro dollar a bit of time to the downside. We've had the pullback trade, and now prices are continuing to the downside. The S&P 500, it's not so bullish anymore. We're now going to test the buyers. So the buyers are now going to be tested, and we have to wait and see who's going to win out as things currently stand. The DAX is looking still quite full to the upside, but we're running into all these lows. So we're at really strong levels of resistance. So let's see how much it has in the tank as far as the DAX to the upside is concerned. So the euro dollar to the downside, the euro pound to the downside, and potentially the S&P to the downside as well. And we'll keep an eye on the other indices markets, see if they follow suit. So that's what we're going to be looking for. I do apologize, guys. We do need to shoot off. Please do feel free to give us a thumbs up if you can, if you found the video useful. And for more information, if you do want to learn how to trade, we can teach you for as little as $15 a month, and that's just daily live trade rooms and a wealth of education and lots of trading tools like your risk management software and things like that. So all of that just allows you to just learn this trade from the bottom up. So on that note, guys, I'll let you guys go. We'll see if we get some continuation in these trades. Let's see what happens over the course of the afternoon. And tomorrow very well may give us some further selling opportunities across the indices markets, and potentially in the US dollar as far as dollar strengths are concerned. So we might get some selling creeping in tomorrow, for example, in the New Zealand dollar, which are trades we would be interested in. So today, little bit of a little bit too many reversals for our liking, but these could be dead cat bounces, and we want to be prepared for that, and potentially get, once they start to reverse, then we could become quite active. So on that note, thank you very much for joining us. Do take care. Do subscribe to our channel. Give us a thumbs up if you can. And we look forward to seeing you again tomorrow from 12 o'clock onwards. So from everyone here at the Live Trade Room, do take care. Enjoy the rest of the evening. Trade safe. And we'll see you tomorrow. Bye for now.